Morning, everyone, and welcome to our course of the month, the Advanced Technical Analysis. Glad to have you on board. My name is Raul. I'm the Coaching and Education Coordinator here at Trading Wins, and it's my pleasure to host these sessions with our head trader, Vince Vora. We have them once a month, and I think for the last little while we may have been a little staggered, but we will make sure that we're having these once a month, and we do owe you a bonus one as well. We'll get to that in just a little bit. First order of business generally is to make sure you can hear us and see us. If you can, please let us know on this bright Saturday morning. Hopefully it's bright wherever you are. First one in, our friend Maria. Maria, nice to see you. Robert from Fresno, I see you as well. Melanie, nice to see you. Jose, Luis, John, Randy from Iowa. Alan, Connie from Tennessee, nice to see all of you. Lots of familiar names. Very, very happy that you could join us. Let's not waste any time. We're going to be going for the next, I'd say, hour to hour and a half. It's going to be a busy session. You're going to learn a lot and really enjoy it. Let's bring in our head trader, Vince Vora. Vince, good morning to you.
Good morning.
Coffee is ready to go? You got the coffee by your side there?
Yes, I do.
The coffee by your side there? Okay, good.
Absolutely.
All right. When we were putting this course together, Advanced Technical Analysis, I know there were certain topics that you wanted to discuss. Tell me a little bit about what we're going to be hearing about today. This is an interactive session, so as you have questions, please put them in the chat box throughout the session, and I'll do my very best to get Vince to answer them as we go.
So this really came about from all the member questions that I've been getting recently, and a number of them have been focusing on really what I believe are the true basics of technical analysis, and more specifically, what the most common things like moving averages, for example. So what I'm going to be doing today I'm going to start off by going over some of the basics. I'll try not to spend too much time on that, and because I'm sure many of you have heard me talk about these before. But then we're going to get into a few of the ways that you could use these basics to your advantage, and hopefully share with you some of the things you've never seen before when it comes to this. But I'm going to be focusing on the items that I have been continuously asked about over the past month or so. So hopefully, we get to answer all of your questions. And like anything else, like what our market chats, if there's any questions you have on technical analysis in general, by all means, type in your question, and hopefully we'll have time to get to it by the end of the session.
When you say the word advanced technical analysis, I'm assuming that you don't need any special tools, software, computers, those kind of things. These are just indicators or use of indicators that's a little bit more advanced than what you normally would teach a beginner trader or an intermediate trader. Is that correct?
Well, actually, what I meant by advanced technical analysis is there's what I'm going to be sharing are ways that I've seen a few of the pros use, but not necessarily anyone else use. So some of you may have seen these before. You may not have. I'm hoping most of you have not. But these are the little twists or the little tweaks to these techniques that most people are unaware of. So I'm hoping that these will be able to help you with your trading. So that's what I mean by advanced. You certainly do not need to know anything at all about technical analysis. We'll start at the very beginning, and I'll share with you the few things that you do need to know about. And by the end of the session, you'll not only walk away with the basics, but a few advanced techniques as well.
Robert from Dallas, our friend, reminds me to remind everyone. He was asking if this webinar will be recorded. Yes, Robert, it is recorded. We want to thank all of you for joining us live as well. So you will have access to it after the fact, most likely by Monday. And having said that, Vince, off you go.
Okay, excellent. So good morning, everyone. Thanks for taking time on a Saturday morning to be with us. This is Advanced Technical Analysis, and what I wanted to do this morning was first just take a moment or two to talk about what it is. What is technical analysis and why does it work? Why do I believe it works? Then go over some of the basics, give you those advanced techniques which can be used for entries as well as exits. And then, of course, spend a good amount of time on questions. I find that many of you here have been trading for a while, have some solid knowledge when it comes to trading and technical analysis, and your questions always seem to be valuable, not just for yourself, but for the rest of the group. So I do want to make sure, excuse me, that we do answer all your questions before we leave. Now, before we get started, please do remember that trading can be risky, so please don't trade with real money until you are completely comfortable with the systems you are using. So let's talk about technical analysis. What is it? Well, I'm going to read off a definition and then simplify it for you. So technical analysis is actually a trading tool that we employ to evaluate securities and attempt to forecast their future movement by analyzing statistics gathered from trading activities such as price, movement, and volume. So simply put, this is the study of price movements in the market. Price action is everything. It's really all you need, but the tools, the chart patterns, the formations, all that is involved with technical analysis makes it easier and not necessarily more effective, but it becomes more effective because it allows us to deal with our own shortfalls and emotions, etc. So, why does it work? Well, because it keeps us from falling victim to everyday emotions, from media reports and from various opinions surrounding us. You're constantly bombarded with opinions and with news stories, etc., that can continuously cause you to change your mind on where the economy is going, where the markets are going, where a particular stock may be going. It's overwhelming at times. If you focus on technical analysis, it really does tell you what the reality is. Price action is everything. So it really helps you block everything else out and focus on what is actually happening. So the way that you can use this to work for you, okay, is to, one of the things you need to do is to transform analysis into action, okay? And what that requires is overcoming fear, greed, and hope. And sure, it's a lot easier said than done, but the point I'm trying to make here is that if you focus on technical analysis, that is the way for you to overcome fear, greed, and hope, okay? Because if you just focus on what the chart and specifically the price action is telling you, there really is nothing else that you need to look at, okay, or listen to or worry about. You don't need to forecast well ahead of time what is going to happen with the price of gold. The chart is telling you what's happening right now, and that's all that matters. You don't have to worry about, are we headed into a recession? Are we, what is the jobs report going to be like 6 months from now? Who cares? The chart tells you everything. That's what you need to focus on, okay? So if you can control your impatience, okay, and your desire to switch away from a sound method that you've been using to something new during a time of temporary adversity, you're a big step ahead. How many times, I want to ask everyone here, how many times have you found a system or a strategy or something that you believe would help you make money, and you started placing trades, and maybe you had a few good trades, and then as soon as you take a loss, maybe 2 losses, you completely give up on it and you move on to something else. You continue your search for that holy grail. Okay? How many of you have actually done that? Right, thanks, Lewis, and a number of you. So you see, many times, a lot of you are saying, yes, I did it many times. Exactly. And Karen says in the beginning, I'm glad you've overcome that now. This is the key to everything, okay? No system is perfect. you're not going to find a perfect system. What you need to do is find a system that works for you, something that you're comfortable with. Whether that's one of my strategies or not doesn't really matter. What matters is that you're comfortable with it and you have success with it. But you have to stick with it and wrap, the money management plan around it. And more importantly, you have to come to grips with it, because that fear, that greed, that hope, if that comes into your trading, that's where everything goes off the rails. Okay? So you really have to have the discipline to believe what you see on the chart and to follow what it's telling you. Okay? Even though you're going to hear many others contradict you, okay? You're going to hear many opinions. You're going to watch news that's going to go completely against what you say, all right? I've seen it many times where I look at a chart and I think, well, this thing's going higher. This is about to explode higher. I'll turn on CNBC and they'll have, Jim Cramer or some other analyst come on and have a completely different opinion, okay? And it doesn't come down to whether or not I'm right or Jim Cramer's right or someone else is right. What it comes down to is, what is the chart actually telling us? And can we interpret what it's telling us? And that's what I want to get across today. I want to give you the basics that you need to interpret what it is telling you. And then you need to build the habits to just follow what it's telling you and believe in it, okay? So the way you're going to lose money is not just from bad analysis, because you can lose money if you analyze things incorrectly. But even if you do so correctly, okay, if you're not able to transform your analysis into sound practice, in other words, if you can't pull the trigger or you can't stick with a trade when you need to, you're still going to end up losing money. And that's really what most traders struggle with throughout their career. So I'm going to give you the true basics, make it very, very simple for you. Only a few things to look at. And I'm going to give you some advanced techniques that will make it even easier for you to follow. Okay? Then it's a matter of practice for you to look at as many charts as you can with these techniques and convince yourself that it works. Now, before I move on to the actual charts and show you these techniques, one thing I want to stress here is that you can look at it and you can say you can use a regular moving average cross system, okay? So we're going to use the 10 and the 20 period simple moving average, and every time the 10 goes above the 20, we're going to buy, and every time the 10 goes below the 20, we're going to sell. Something very, very simple that you can see on the chart very clearly when you need to buy, when you need to sell, okay? Now, the question is, if you do that, but you have trouble actually pulling the trigger when you need to buy, or you have trouble staying in the trade, then there's other things going on with you. You have fear of something, okay? You're either greedy or you're hopeful. Your emotions are coming into play. And one of the best ways to overcome those things is to put parameters in place that won't allow you to ever get hurt in a really bad way. And what I mean by that is, if you use the money management plan that I've given you in the past, there's no way you can ever take a big loss. And so the numbers have to work for you, okay? See, I already see many comments. As I'm talking, people are writing in, and like Karen, I hope you don't mind. I'm going to share your comment. She says, lack of confidence when I leave a trade too early. See, you're focusing on the wrong thing. You're focusing on yourself. You're being hard on yourself. You're blaming yourself when you leave a trade too early. So if you left that trade too early, there's a reason for it. Most likely fear. Fear of it turning around and you giving up your profits. Fear of it turning into a loss. Fear of you turning that trade into a losing trade and then having to, tell your spouse or someone else that, hey, I took that losing trade, and worry about what they say. There could be many, many reasons. But if you're leaving that trade too early, rather than following what that chart is telling you, then your emotions have come into play. And that's what you need to remove from your trading. And the way you do that is by controlling the trade itself with that money management plan. So if you have 10 contracts in there and you're worried about it, which is why you leave early, because there's a lot of money on the line, you have a real nice profit, and you're worried about it turning into a losing trade. Well, what if you had one contract only? Would you feel the same about it? Because if your answer is no, I wouldn't care less. I could hold one contract forever. I wouldn't fear one contract. Then that's what you should be doing. You should be going down to one contract, and then only when you're comfortable to go to two, and then go to three, etc. You have to trade within your own comfort zone, because when you're comfortable, you can think clearly and you can follow what's on your chart. When you're uncomfortable, that it's for a reason, either fear, greed, or hope. One of them is coming in, but your emotions are coming into play. So the techniques I'm going to teach you today are going to make it a little easier for you, a little visually much easier for you to spot what's going on when, okay? But you still have to trade within your means so that you can follow what you see on the chart. Okay, when you spot the setups I'm going to teach you, you can actually act on them. Michael is saying, I'm successful in paper trading. However, with real money, I haven't been successful. But probably because I'm super conservative, very tentative, and leave early. Again, this is very common. I struggle with the same thing for many years, and I'll be honest with you, I still struggle with it. I've told many of you my story of how I lost huge money when I first started trading, and those are scars that will never leave me. Okay? Every time I sit and go to pull that trigger on that trade, I get that same knot in my stomach. And I've entered thousands and thousands of trades since that happened. I've made that money back many times over. That scar is there. What you need to do is recognize why you're feeling the way you're feeling, and then push through it. The way I do that is I understand where that feeling comes from. It was from that big loss and the fear of not ever wanting to take such a loss again. But when I feel that way, it's a matter of pausing for a second, telling myself, yes, I understand why I'm feeling this way. It's because of that loss. And telling myself that it's okay to feel that way because there's a good reason. You know, I don't ever want to take a loss like that. But it helps me also check off the little boxes before I place that trade, meaning, have I protected myself? Am I pulling the trigger on a trade that could result in another loss like that or not? And the way I set up my trade today compared to back then is much, much different. Today, whether there's a flash crash, whether there's a 9/11, whether there's some North Korea thing, it doesn't matter how surprised the market gets and how big of a gap against me happens. I will never, ever take a large loss the way I did just because of the way I set up my trade and the number of contracts I trade, etc. So that you need to set yourself up in a way that you are comfortable and confident that you know going in, you're not going to get hurt badly. And whether you take a loss or not isn't what matters, okay? Going back to Karen and Michael's points, just because you take a loss, it doesn't mean anything. If it hurt you too much financially, you're trading with too much money. You're going in with too big of a size. If you're worried about what other people think, that's the wrong way to look at it. What you need to do, okay, this will be my last point before I get to the charts and start teaching you this stuff. What you need to do is focus on execution. So if you know, if you structured your plan ahead of time and you know that when that 10-period moving average crosses that 20, you need to buy, and you know exactly how many contracts to stay within your money management plan, and how, when and why you're going to exit, and all of that. You've done all your planning. Your focus should be, am I following the rules? Did I enter the trade the way I was supposed to? Did I exit it the way I was supposed to? If you can answer yes to all of those questions, whether you took a loss or not, doesn't matter. Losses are going to happen. They're a cost of doing business when it comes to trading, okay? But over time, if your plan is solid, you will make money and make very good money, okay? So, and you'll know very quickly whether your plan is the right plan or not, okay? I'm teaching you the way I do it. It works for me. But if you don't get your emotions under check here, in check, it'll never work for you. So you have to set up the trade the way it works for you. Now let's go through this. Gwen was saying, where can I find the money management rules? Gwen, on most presentations that I do, I go over the money management rules at the beginning. So any of the previous webinars that you've seen me on, chances are they're there. If you have the recordings, go back to it. If not, just call our office. We'll send you one of those webinars that have the money management rules at the beginning of it. You watch the first 5 minutes and you'll have it, okay? Anyone who wants that, just send us an email and we'll take care of that for you, okay? So, Raul, if there's any other major questions for me to answer right now before I get to that, on what I just spoke to, glad to answer it. If not, I will start with the technical analysis techniques.
John was asking, he says, Vince, I have several stocks that set up on the winning momentum strategy on Friday. Then I'm waiting for the trigger on Monday. Would you consider pacing a buy stop order so the price doesn't blow through it? My observation is that oftentimes a stock hits a trigger, especially a pivot trigger, volume pours in and it moves substantially very quickly.
Absolutely, you can use buy stop orders. All I would do, though, is double check if you can. I mean, if you don't have to go to work or anything during those times, if you can pre-market, just check the futures, make sure that the market isn't going crazy, because there could be an announcement over the weekend that would cause the markets to gap up, let's say, sharply. And if that's the case, you'll notice it in the futures. If everything's normal, and you can absolutely use a buy stop order. Absolutely.
Dominic says, I trade small and I don't take profits when they shoot up because, one, I don't want to exit early on a winner, and two, since it's one lot or 100 shares, I can't see selling an odd lot. I think only of selling 100% and can't. Perhaps if I traded larger size, I could take profits on the way up. Vince, I know you're going to discuss a little bit of exit techniques and the fear of getting out too early.
So we will. And that all comes with being able to read the chart and knowing where it's at and knowing when you should leave and when you shouldn't. Your goal as a trader is to make enough money so that you can go to 2 contracts, and then 3, and then 4, and then 5, etc. So, and you know, if you follow these techniques, it really shouldn't take you that long. But regardless, you can make millions and still be at 1 contract, okay? You need to do what's comfortable for you. Whether you're making $1,000 a year trading, or you're making $100,000 a year, or $1 million, what matters is whether you're comfortable. Because if going to 2 contracts from 1 makes you so uncomfortable that you're going to start bringing your emotions into your trading, then you're going to start taking losses. So don't do it until you're completely comfortable. So let's talk about the basics, the true basics of technical analysis. What do you need to know? Well, you need to know 3 things. Price action is number 1, and I'm going to take 5 minutes and go over that. And then pivot points and trend lines are what you need to know. Then all the added stuff like charting patterns and indicators like moving averages, etc., those are all other tools, extra tools that you can add to your arsenal. But price action, trend lines, pivot points. If you stick to those 3 things, you will at any point in time know exactly what's happening on that underlying security and know exactly whether you should be in buy mode hold mode, sell mode, or anything else. Okay, so let's look at Apple here. Now, very quickly, whether you're using candlesticks or you're using open, high, low, close bars, it really doesn't matter. What matters is what they're telling you. So I'm going to focus, I'm going to zoom in on this area here, and hopefully you can all see this very clearly. Now I'm going to highlight this here. This is a bullish engulfing pattern, which most of you know we use for entries sometimes. So rather than explain what that is, let's just say that that's where I am going to go long. On any trade above the high of this bar, the Jan 17th bar, I'm going to go long Apple. Okay? How much I buy, whether I use option stocks, doesn't matter. That's where I'm getting in. So you can see on the very next day, we traded above that price. So this was my entry right here on the 18th. So when you look at this, what has been happening with these bars? What do they tell you? Well, first of all, let me just zoom in on this bar here if I can. Let's see. Let's start here. What is this bar telling us? So whenever it's a green bar, the reason why it's green is because it closed higher than where it opened. The reason why a bar is red is because it closed lower than where it opened. Okay? So when you see the box here, the body, it means your open was at the bottom edge of the body and your close was at the top. For a red candle, your open was at the top edge and your close was at the bottom edge. The wick or the tail here points out your lowest point during that session and your highest point. Okay? So here, this stock opened here. It went as high as here. It may have fluctuated throughout the day, but it came back and settled here. Okay? Now this was on a gap. Okay? So this one opened here, went as low as this point, as high as this point, and closed here. For the red bar, we opened at the top edge of the body. Throughout the session, at some point, we went as high as this point, as low as this point, and then we settled here. Okay? So what does that tell you? If you think about this, if we closed here before, okay, now we're opening down here. We have a lower open. Okay, we go slightly lower, and then people start buying, and we go all the way up here, and then we close down here. So, is it green? Yes. Are buyers in control? I mean, certainly there was more buying than selling, but if you look at the previous close, we actually closed a little lower, right? So, these are the things you have to put into perspective. Number one, look at this one. It gapped. It opened up here, but this was the previous close. So it opened here, went as high as here, and came down here. If you were to look at this bar alone, you could say, well, yeah, we opened here, buyers took control, went all the way up here, but then it faded, and we lost half of that, right? So yeah, you know, buyers went out, but you know, they faded. We lost half the session. But look at where we closed compared to the previous close. There was an enormous amount of buying here, right? Buyers fully in control here. So the size of the body matters. The length of these tails and wicks matter. Okay? But what you need to gauge when you're reading a candle is who controlled this particular session, whether it was a day, whether it was a 5-minute candle, was just a 5-minute period throughout the day, whether it was 15-minute or a month. Okay? Who controlled that? And then who's in control overall? Okay? So we can say here, this red candle, that sellers controlled this. Okay? So we closed here. We opened pretty much where we closed the previous day. Then buyers stepped in and brought it up here, and then sellers said, no way, and started selling it off and took it as low as here and then closed in here. So sellers did control this session. Was it a huge amount of control? Not really, because the body wasn't very wide. The wider the body is, the more significant the candle is, okay? But if you look to your left, who's in control overall here? Well, clearly buyers are, right? So as long as candles are making higher lows and higher highs, buyers are in control. As long as candles are making lower lows and lower highs, sellers are in control. Now, when you look back, it's much easier to say, well, yeah, buyers were in control here, sellers were in control here, buyers here, sellers here, right? Hindsight's 20/20. But if you just read it one candle at a time, you can also reach that conclusion at whatever point you're at. So here, for example, now we see this green candle. Can we say that buyers are in control overall, or are sellers still in control overall? Pretty clear that sellers are still driving this lower. We just had a decent day on Friday, right? So now what matters is the next candle. So going back to this example, if we had gotten in here, okay, we know where our stop is going to be. It's going to be just below this candle, for example. I'm going to mark that. So whether you got in with one contract or 100 contracts doesn't matter. What matters is what the price is telling you. So if we got in here and then it triggered and pulled back by the end of the day and closed slightly below that trigger point, is there reason to have any sort of concern yet? There isn't, and I'll tell you why. Because until you close below the low of a previous bar, there's no reason to be concerned. So first of all, you decided before you bought here that your stop was going to be here, which means you should be comfortable with the level of risk from here to here. You should know in dollars what that means to you, how big of a loss. And if you weren't comfortable taking that size of a loss, you should have never taken that trade to begin with. Okay? But if you did, then you're fine. Did you follow the rules? Did you enter on a break of that high? If you can answer yes, you've done your job. Have you entered your stop loss? Great. Now sit back and watch. And now here we are, we closed slightly lower. The next day, here, we closed slightly lower again. But did we close below a previous low? We did not. So there is no reason to panic here. Next day we bounce. Even though it's a red candle, we still closed higher than the previous close. So buyers still dominated here. We're good. So if you follow this along, at what point did we close below a previous low? This one here, maybe. Let's see. The low here was 121.60. The low here, no, it was 121.63. See, we still closed higher than the low. But let's say we did, this close was lower than that low. Then we would mark the low of this candle, and on any trade below it, we'd be out. In other words, your stop would go from here to here. Okay? But we didn't. We did not close below that previous low. Then it gapped in our favor. And then here it just kept going higher and higher and higher. Is this candle any reason to worry? No, it has not closed below that low. Are any of these to worry? Even though each candle is going to tell you a story. Like this one is an indecision type candle, right? Or the dojis you can look at. They're usually at turning points, at either the highs of a current move or at a low of a current move lower. So you could look at this and say, the end may be near here, and we may be rolling over. But do you do anything about it? Do you need to do anything about it? You don't. If you're already comfortable with the level of profit you have up until here, by all means, take it off the table. And don't kick yourself for doing so. If that's what feels comfortable, do it. But try on every new trade, try to stay in a little longer at a time. You're not going to overcome those bad habits overnight. It's going to be a process, okay? It's going to take time. But by reading the candles and understanding what's going on and trading with proper size, you should be able to overcome that. So if we really look at this trade, at what point did we close below a previous low? Okay, if we really look at this and follow it through, here's the first time, this candle. Okay, now we would mark that low, and did we trade below it? No, so there's still no reason to exit. And if you look at this candle itself, although we closed below that previous low, this is a bullish candle anyway. Why? Because sellers took it all the way here and buyers pushed it all the way back up before the end of the session. So yes, we closed slightly below the previous day's close there, but it's still more bullish than it is bearish. And then we continue on, right? And the only time this one did not trade below here. This one closed below that low, but then the next day it still did not breach that low. So the only time that happens is here. This candle here, the April 7th candle, closed below that previous candle low, and the next day it traded below that candle. So your entry would have been here at 120 and change. Your exit should have been here at 143 and change. All right? If you followed price action. Throughout, there were many times to be worried. Look, there's a bearish engulfing setup here, isn't there? Should we panic and get out? It didn't trade below that low. No reason to be panicked, right? The chart will always tell you what's going on. It's your job to follow your rules. Now, if your rules say that when you get in, as soon as you have a 10% profit, you're out, then so be it. If that was here, you'd be out. If that was here, you'd be out. Whatever it is. If that's your plan, that's your plan. Okay? You need to focus on following your plan, not becoming the world's greatest trader or worried about, what's my husband going to say, or what's my wife going to say if I exit here, or what if, I'm telling her, wow, honey, we're up $2,000 here, and then the next day it gaps lower, and I have to go back to her and say, well, actually, we're now down 500 instead of being up 2,000. If you're worried about those kind of things, you really shouldn't be trading, okay? And those are completely natural. I'm not trying to offend anybody, but those are emotions. You cannot bring those emotions into your trading, okay? You don't have to be a robot, but you need to follow what the chart is telling you. What happens is this. No system is perfect. So there are going to be times when you get into a trade like this, and immediately you'll get a close below previous low, and it'll breach that level slightly and then take off again. So you'll have exited here, and then you'll see all this, and you'll go, oh, wow, what an idiot. Why did I listen? Why didn't I stay in there? You do not have a crystal ball. You never will. So unless you're psychic, you will not know what's going to happen next. But following the method I'm giving you, in the long run, will pay off in spades. Okay? Yes, there will be trades that will get you out immediately, and you'll miss out on that run, but there'll be runs where you're going to catch that whole run, and it'll more than make your year. So follow the price action because it's absolutely everything. Are there any questions on that?
A couple of questions. Vince, let's go back. Dominic following up, saying on my mental issue of not taking a profit, I've got a couple of symbols that he mentioned that were up 40%, but now are up 20%, and I feel stuck holding because I didn't feel like I took some profits off the table. Then Sam chimed in saying, I don't understand why you would take part of the profit when you can let it ride and take it all, especially if you're using a trailing stop.
So there's a couple things. It all depends on what your trading plan is. So for example, me, I would trade with multiple contracts, okay? So what I'm doing is, if I got a gap in my favor, I'm taking some profit. I consider that a gift. It's a rule that I follow. If there's a gap in my favor, I consider that a gift. I'm going to take some money off the table, even though the candles are not telling me that it's time to get out. What I'm comfortable with is taking part of my position off and banking some profit. So I'm reducing my cost basis, if not eliminating my risk completely, and moving my stop up. So now I can worry even less. Now I'm totally risk-free, and I'm perfectly comfortable holding this even longer. Then if it goes up another amount that I'm comfortable with, I take it off. And it doesn't have to be a dollar amount. It could be a Fibonacci level, right? If we used our Fib extension tool. All right, so let's say we had our Fib extension. The trade was here. Here's the previous low and high. If we plot our extension tool like this, right? I would have taken some profit at the 127. Then it totally gapped above the 161. I would have taken more. And then here, you know, depending on how many I had left, I might have taken it or I might let it ride until the price is telling me to get out, which is here. It's what makes you comfortable. What matters is, are you following your plan or not? Because is your plan flawed or are you flawed? That's the big question here. If your plan isn't flawed, if you were right to stay in here because that's what the chart was telling you, okay, then there's nothing wrong with it. So getting out early would be a mistake unless it was part of your plan. Like I said, some people trade, they look at percentages and they say, I am only going to allow this to go against me like 8-10% max, but I'm going to take profit at 20%. So whenever I take profit, my profit is more than double than any loss I would take. So now, even if I win 50% of the time and I lose 50% of the time, I'm going to make money overall because my winners are twice as big as my losers. And those numbers work for them. So it's what works for you. For my plan, I like scaling out along the way. Okay. You can absolutely stay in there the whole way, whether it's one contract or 10 along the way. But the reason why I think it's good to scale out along the way is because you never know what's going to happen, and you're not always going to get a clean exit up in here. We could get a gap in the opposite direction depending on news. So overnight, you may have been up 100% on this trade, and then overnight it comes down to 50, or it comes down to 20, or it goes into negative territory. So for me, getting out along the way and eliminating my initial risk is very important to my psyche and the way I can allow myself to stay in the remainder of the trade. So I do that because it makes me comfortable. Okay? Hope that helps.
A couple of other questions as well. Karen was asking, would you be moving your stop? And if so, do you have a rule for that? And Connie says, I do follow your method and do well with it. However, I find myself becoming impatient with consolidation periods, such as the one we seem to be in now. Do you have any wisdom about staying in once it starts to go sideways?
Okay, so you need to ask yourself, why do you feel impatient? Okay? Why do you feel impatient? So if you're not finding enough setups for yourself and you want to be more active, maybe you need to broaden your scope of what you're looking at. So, for example, I looked at the Dow 30, the 100 in the NASDAQ, and 500 in the S&P large cap, right? That's my basic starting point. If I can't find any trades in that, then I widen my scope, okay? I go to the Russell. I look at all the stocks in the NYSE. There's 3,000 of them. You can do that to find setups. There'll be a setup somewhere. But if try not to force your trade. Let the trades come to you. If you're in a trade like Apple, like this, for example, and then it starts going sideways, and that's why you're impatient, is like you're sitting on this profit. You're waiting for it to give you an exit, but now it's just going sideways. If another setup comes along that looks strong, get out of this one and put your money there where you think you're going to get the biggest bang for your buck. So you can justify getting out early at certain times, okay? But you can't justify getting out early if it's because you see a little red candle after 5 or 6 green ones. That's not a good reason why you want to get out. If your reason is, well, this stock seems to be going in a channel now, and it's dead money where there's another trade setting up real strongly, and I think I can make more there. That's a good reason to switch. Okay? So if we're in a period of consolidation like we are now, and you're frustrated and you want more action, maybe you can lower your time frame. Go to the 15-minute, go to the 5-minute. Maybe you'll find setups there. Okay? That's not a major problem. what I'm talking about is as being a problem or bringing your emotions into your trading. So if you're following your rules, great. If you're not, it's going to be a problem for you.
John was asking a couple of different questions from two different fellows named John. First one was, I trust Vince would be moving the stop as the Apple trade progressed, or only when it closes below the previous low? Question mark.
No, and yes, I would be moving the stop. Again, using targets with the Fibonacci's, I may move my stop just below those new levels, or on the dollar amounts. Like again, if it gaps like this to me, I don't want to now give up that profit, so I'm going to take some, and I am going to move my stop up. You can also use a 2-bar trailing stop if you want to do it tightly. Go back 2 bars and put your stop just below the low of 2 bars ago, right? And just continuously do that. That's a nice tight way of doing it. You can use something like the CCI. When the CCI goes from positive to negative, exit the trade. Find an exit strategy that you're comfortable with and use that. Or you can just put a trailing stop with a dollar amount, right? So trail it $1 behind the price or so on. Whatever is comfortable for you. The exits are important, but they're not as important as you dealing with your emotions. That's what I'm trying to show you here, is that most of the time, the reason why traders exit is because of an emotion, not because of what's technically correct. And that's the difference that you have to focus on.
John from Fort Myers was asking, Vince, would you have held through earnings here?
No, that's another thing that I probably would not have done. Okay, if I'm up nicely on that position, I would have taken at least 3/4 of it off and maybe left a quarter on earnings. So for me to look at this trade and say that I would have gotten in here and stayed up until here, no, I would not have done that myself because it's something I'm not comfortable with. That's what the price was telling us. But we all know that earnings could go either way. It could have gapped big time to the downside just as much as it did to the upside. So for me, I would have gotten in here. First of all, I would have been too close to earnings for me to even get into this trade. Okay? But if let's say I got in back here and I was here the day before, I would have taken 3/4 at a minimum, if not all, off the table. And then if it gapped and it continued running, so be it. I don't kick myself when, Raul, you know me. You know that when I'm in a trade and I sell it, I remove it from my watch list so that I don't go back and look to see if it continued running up because I don't want to play with my mind that way, right? I'm happy with the amount of profit I took. I run, and that's it because it's what I'm comfortable with. But I'm trying to teach you that price will tell you everything that's going on. So yes, there's many other parts that come into play, but if you follow price, it's always going to tell you exactly what's going on. If you see here that there's this little red candle and you turn on CNBC and it says, well, it looks like Apple is being sued by Qualcomm because of a patent infringement, and you're thinking, oh my God, like now they're going to get sued, now this thing's going to go to hell, I better exit. And then the next day this happens, right? Those news stories are useless when it comes to trading with technical analysis. If there was a real problem with Apple here, price would have told you that there was a problem. This would have been a much bigger red bar, okay? Or there would be a lot more selling coming in, and it would get you out of that position. That's the frustrating thing about news. They cause gaps like this, whether it's earnings or any other news. And gaps are an enemy of yours when you're trading, but that's what your trading plan is for, is to fight against that enemy.
Question from Jeff, Cedar Rapids, asking, with Friday's activity on Apple, would you have considered getting back in?
No, I would not have, because buyers are not in control yet. Now, we trade with other indicators. If we throw on our other indicators, maybe there would have been a setup. I don't believe so. Let's go back to our winning momentum strategy, for example, and throw on Apple. You see, is it telling me to get in? Not at all. In other words, it's more telling me that there's a short setup coming here. We're below the cloud. We have downward momentum. We're making our way back to that downslope in 20. I'm looking for a reversal signal now, you know. But what are the candles telling you? There's a lot more selling going on here than buying, right? So if we look, if I was short here, now, did we close above a previous high here as we're going lower? We did. So what I would do is mark the high of this candle. Okay, that's if I was short here, which I would not have been. And if we get a trade on Monday above that high, then I would exit that trade, right? And then probably we'll get a reversal signal and I'd be back in short. But right now I'm looking actually for a short position on Apple, okay?
Lena says, Vince just wanted to confirm if the candle closes below or above the previous candle or the break of the range of the previous candle.
No, so if you're long, you only have to worry if a candle closes, if the close of the new candle is below the low of the previous candle, okay? It's not the low below the previous low, it's the close below the previous low. And if you are short, okay, it's a close above a previous high, okay? A close above a previous high, not a high above a previous high, a close above a previous high. That's really the only time you have to worry. Mm-hmm.
Sorry to speak over you there. Melanie says, Vince, you've discussed the, quote, one candle will not take you out, you need two, back last year, and found this to be very calming, especially in pullbacks in day trading. I've staying power now. For me, this kills the panic, which I felt before with the holy cow, quote, holy cow, it's going against me feeling. And she says, I firmly recommend it. Thank you for that, sharing that.
Yeah, but you see, if you're still going in with too much size, too much money in the trade, then even that one candle trick is not going to help you completely. So there's both parts of it. There's the money management side and the technical side. Okay. So
Nancy says,
go ahead.
Go ahead. Nancy says, Vince, when we have leaps such as in Citigroup, you wouldn't be getting out of those because of earnings, would you?
No, I would not. Not with leaps. I would not. But remember, what you're doing with leaps is looking at the monthly chart, right? So you're kind of doing the same thing. On the daily chart, we may see a lot more fluctuation. On the monthly chart, if we look at this, is there any reason to get out here? No, there isn't, right? So that's the difference. But no, if I'm holding options, if I'm holding leaps, I do not worry about earnings at all because that's a temporary thing. I'm looking much more long term.
Kevin says, I'm getting overwhelmed with too much data. I don't know if he means in this particular course that we're doing today or in general, but that is a problem where people get overwhelmed with the amount of information that's available.
Right, and this is another reason why you need to start, find a starting point and only move to the next point when you're completely comfortable. So what I was hoping today was give you a couple of techniques that you could use that are very simple and easy to follow, but the intent is not for you to jump in and start using all of them at once, but to work your way through. So I'm already amazed at how we're almost an hour into this and we haven't gotten off the first point, and I've got at least 10 to share with you. So this may turn into another one of those where we got to do multiple sessions because we're really truly only on the basics yet. I haven't shown you anything advanced yet. But don't worry if you're overwhelmed. That's another reason why we record these sessions, so you can go back and listen to it and process it. Take your time with this. It'll all come together for you.
Louis says, Vince, do you only scale out, or do you also add to your position if the trade is going in your favor?
That's
if you ever try it.
Yeah.
And what's your input?
That's only if you're more aggressive. Okay. If you see another reason to get in. Another setup along the way that you could add to your position only if you're more aggressive. Otherwise, just focus on dealing with the trade at hand. Let's try to move on. If there's questions I haven't answered yet, I'll try to come back to it. I want to at least get a couple of the basics in here before we go on to the advanced stuff. Okay, so a couple of things that are very important are pivot points and trend lines. So the pivot points, for those of you that are new, are these. Any stock, when it moves, doesn't go in a straight line. So up or down, what you're looking at are these turning points. These are the pivot highs. These are the pivot lows. Okay? And it happens the same way to the downside. So for example, here, if you look at this price action here, we were making higher lows and higher highs. Okay? And now suddenly we get a candle with a lower high and a lower low. Okay? And then the very next one, though, has a higher low, higher high. That makes this a pivot low, just like here, okay, and here, okay? And these up here are pivot highs when it happens in the opposite direction, okay? So it's usually it's very easy to spot the peaks, okay? So you don't even have to worry about the definition, but just look at the peaks. Those are all pivots. The reason why those are important is that those identify areas of support and resistance. Okay? They will become future areas of support and resistance. So what you need to do is get used to just drawing a line. So when you see a pivot, okay, just draw a line and stretch it across. Okay? You see a pivot here, stretch it across. Those are future areas of support and resistance. Look, if I take this high here and I stretch it across, at this point when we made this pivot here, we had no idea what was going to happen in the future. But it came here, it hit it, and bounced off. Then it went through, came back, hit it, bounced off. So you can see how it becomes an area of future support or resistance. Same here. And it's not a perfect, right at the peak. It's a zone more than anything. But you can see again here, this point acted as support. Okay, you take this one across. Okay, all of these. So even though this is on its own, at some point in the future, this will become an area of support or resistance for the stock. You don't just draw them horizontally either. You want to connect them. So if I take this and this, have a look at this. All I was doing was connecting these 2 points. So once we came back here and bounced and created this pivot, as long as you have 2, you can draw a line. The more points that touch that line, the stronger the area of support or resistance that becomes. So you can see here, once I drew that and I extended it out, now suddenly we hit here and it acts as resistance, bounces back. Here it gets close to it, and now here hits it and gets rejected. And where it's really powerful is when the areas come together. In other words, here there was a line this way and a line that way. This would have been a very strong area of overhead resistance for this stock. Okay? Just like here. So drawing those lines matters. So now if I take this point and this point and I try to draw it across, I know that as this is coming below here, this is going to be an area of support. Yeah? If I draw this and this, okay, there it was support here. Now it broke through. Where is it going? It's going to the next level. So I want you to really build the habit of drawing these lines and being able to read this. Now, you don't have to keep these lines on forever. The way I do it is I look at where I'm at now, here, and I want to try to identify that if I were to take a short here, for example, where am I going to run into support or resistance here? So I'm going to look to my left and I'm going to find these peaks and I'm going to draw a line across. Okay? Draw a line across. And so I can say that, yeah, these are my areas where, this can run into a problem. Okay? But if I'm taking a short and the very next level of support, the very next pivot, isn't until down here, for example, now I know that, hey, I'm going to have a lot of room for this to run. This could be a really good trade candidate, right? So very, very important. And as you use the other techniques with whatever strategy you're using, these pivot points and the trend lines really do help you. Support and resistance is huge when trading with technical analysis. And you'll see it come together with the other points that we're using. The other thing is chart patterns, right? So we know the major chart patterns, like a cup and handle, for example. Let me show you an example of a cup and handle. And I'm not going to spend a lot of time on this. I'm going to show you one example of each, and then I'm going to move on. So a cup and handle is where you have sort of a rounded bottom. That's the cup. And see, this isn't perfectly round, but we came lower here. We got back to these highs. Then we pulled back again. And then we busted through. So here, this is the cup. This is the handle. And on a break of these highs here, that's the break. Now, where this becomes important is that a lot of times on these breakout areas, you will get setups, okay? It's not just the fact that it's breaking above that previous high that triggers the cup and handle, but you might get a bullish engulfing pattern here, or you might get, you know, a winning momentum system trigger. When you see that pattern happening along the same spot where you're thinking of going long because of whatever strategy you're using, it reinforces why you should be taking that trade. It makes it even stronger. And drawing these lines on these pivots and so on are going to help you identify those patterns as well. Okay? So that's a cup and handle. You can also look at an island reversal, for example, like this, where you get a gap up and then a gap down. That leaves all these candles on an island of their own, right? That's a very significant reversal pattern, right? So when you get that gap, now you mark the low of that bar, and if there's follow through, then you should go short, okay? Happening in the opposite direction, you should go long. But again, drawing those pivot points here will tell you when it's going to hit support or resistance. Where, so if I'm here and there's an area right there, you see, it got there, it triggered, it moved below that bar, it hit there and it bounced. And then we were above it for a very long time. We hit it and bounced again, and then we finally broke through. So this will help you identify how far away that support or resistance is from your entry point, and you know how much profit potential you have in that trade. They're very, very helpful that way. Okay, double tops and double bottoms are also big charting patterns. So here, you come back, you make a high, you drop, you come back around that same area, and you collapse. Normally, you'll notice very clear reversal signals. There's a bearish engulfing setup. There's another one. Okay? So this one, you may have just been looking at this here as when do I get out here if you were long. Okay? You were not looking at a double bottom initially here. But once it retested and gave you a bearish or a reversal signal, now you start thinking double top. What's important is the midpoint between those two tops. You mark that here. If you get below that, that's what confirms that pattern, and now you drive lower. Where's your next resistance point, right? Draw those lines. Okay, now, those are basics, okay? Those are basics. If you understand those, you can do a lot with trading. But let's try to tackle some of the more advanced techniques. Raul, unless there's any major questions here, I want to make sure everyone understands what I've taught so far, because those are the basics. But otherwise, I'll just continue on here.
Let's continue. I don't see any other big questions.
Okay. So one of the things that's important. Another pattern, and here I'll just show you a quick example of this, is an ascending triangle or descending triangles. Sometimes you'll have like here, for example, if you get used to drawing lines, okay? Oops, what's this? Okay, you'll get this kind of pattern. Okay, where you were climbing, now you're pulling back, and you're drawing those lines to judge the breakout here. Okay, this is a very strong pattern. So if you get that breakout, you can consider going long there, right? But how long is this going to go? How far can you expect that move to go? A quick way to measure that I'm guessing most of you would not know is this, to measure the top and the bottom of this move. So if we look at price here, we went from about 174 and I'll call it 175 to about 193 or 94, we'll call it, okay? So what is that, about 19 points or so? If we look at here, and now if we go from 194 up here to 214, what is that, about 20 points, right? It's about the same distance. You see that? So if you measure this, it's actually about the same distance from here to here. So if you were targeting 19 points from your entry, okay, you'd be around here somewhere where I'm sure you would have scaled out a couple times along the way. Maybe you would have been triggered out, like here. So this would have got you out anyway, okay? But then you might have gotten back in and you still know that this has about 19 points in total to go. That's the norm. Now, it doesn't mean that you just use that hard and fast and you say, well, if this is 19 points, this is going to definitely move 19 points, so I'm going to ignore these areas where it's telling me to get out. No, you're not going to ignore it. You will get out, but if you get another long signal here, you might take it based on that. But that's just one trick for you to measure. Whenever you get an ascending triangle like that, it works the same way to the short side. Measure the start of the move to the end and expect the same distance. Sort of like channels, when we measure a channel and then expect same distance move, okay? Now, many of you trade with moving averages, correct? I know I use the 20-period moving average a lot, but I know one of the most basic things in trading is a moving average cross system. So I'm going to do something very simple here. I'm going to throw on a couple of moving averages, okay? Simple moving averages here. We're going to throw on the 10 and the 20, all right? So let me just throw this on quickly. We'll put on the 10 and the 20, and we're going to look for those crosses. Now, I wouldn't use this strategy, but it's very basic, right? When the 10, which is green, crosses above the red, which is the 20, you can consider going long. Or when the green crosses below the red, you can consider going short. Well, one of the biggest problems with a moving average cross system is the chop. These areas that are sideways where it continues to cross above, then below, then above, then below, and you're getting in and out quickly, taking a loss, back in, back out quickly, taking a loss. When the market's trending strongly, sure, it's easy to make money with these, but when it's not, it's very difficult. So one of the things, the simple things you can do is just confirm that if you're taking a long cross here, a trade to the upside, that it clears a previous high here, okay? So if here's, and look, normally the candle with the cross here was this one right here. It was already above that high, okay? So just make sure that it's already cleared a previous high for a long or a previous short for a low, okay? So here, if it crosses, did it clear a previous low? That's what you need to confirm. That will save you from most of that chop. If any of you are using moving average cross systems, that's one thing that you need to definitely understand or know that will help you improve what you're doing. Okay? Now, the other thing you can do, how many of you use the 50-period moving average? Because one of the reasons why I did this class is I've been getting so many emails saying, well, I know you use the 20-period moving average to judge momentum, but what if I use the 50 instead? Because I really like using the 50. I know there's many of you that are using the 50. Okay? Let me show you something. Let me clear this off, first of all. I'm going to put on a 50-period moving average. Okay. Let's go to the simple here. And then I'm going to put on a different one here, an exponential. So the simple is going to be a 50. And I'm going to make that red. And then I'm going to go to exponential. So how many of you look for bounces off the 50? Right? You use the 50 for a period for an area of support, right? Okay. So I'm going to throw on a 50 period, which is red, and a 65 EMA. Okay? So Connie says yes, she uses it for bounces, and several others of you. Rick says he uses the 50 and the 200, etc. The 50 is very, very popular. So if any of you believe that market makers and others are gunning for stops, many of you look for bounces there and put your stops just below the 50. Correct? The 65 EMA is what a number of pros use, okay, to allow for that buffer. So you come below, it'll wipe out a number of stops, it'll bounce right off that 65. Okay, and use an example. Let's look at something like Microsoft. There it is, a number of times. Now, we can throw on any number of moving averages, and you're going to find spots where it'll bounce. But if you look at this across many charts, you're going to see that when there's dips below the 50, more often than not, it will bounce off the 65. Okay? So again, this isn't something I use, but from the emails I'm getting, I'm trying to give you something that will help you improve what you're working with. Okay? So have a look at that. And let me show you one other thing that may help you. A long time ago, I shared a very, very simple and easy system that you can use on the monthly charts, which is a 10 EMA. Now, I don't know if Matt's here. I know Matt is one of our members who uses this a lot, who really liked it. I'm going to throw on a 10-period simple moving average, okay? Just a simple 10. When it comes to the monthly chart, the 10-period moving average works extremely well. In other words, price will stay either above or below that moving average for the bulk of the time. There's very few crosses. So a very simple way to trade or invest for the long term is to use the 10-period moving average. Okay? So when it crosses and breaches a previous high, you go long, and you stay long until it closes below there, right? And vice versa. Very simple, extremely effective. Don't take my word for it. Go back, look at charts, and you'll know what I'm talking about. But now I'm going to show you another way, and I hope Matt is on here or watches this later on. There's another way to do this. I'm going to throw on another moving average here. It's also going to be the 10-period, okay? But this time, it is going to be the 10-period weighted moving average. Okay, basically it gives more weight to the more recent candles. 10-period weighted moving average. And what color should I make this? I'm going to make it blue. Yeah, that's visible. So as long as that 10 period weighted is above the 10 period simple, you're good to stay in that trade. Okay? It may not look much different here, but trust me, there's many times where it will make a huge difference for you. Let me show you a few other examples here. Give me one quick second. Let's look at McDonald's. Okay? So it's a very simple system, but very effective, especially on the longer time frames. A 10 period weighted and a 10 period simple. You get that cross. I would personally wait for a break above the previous highs, but you don't necessarily have to. Okay? Get that cross, you stay in it. You see here, price dipped below, moving average did not breach the 10 period simple. Okay? So, again, you can put any twist you want on it. You can take this as an entry and then use the price action method I showed you early for when you exit, or scale along the way, do whatever you want. But this is also an effective way for the indices overall. If you look at the S&P 500 here, is there any reason to worry or think we're headed towards a rollover or a bear market at this time? Really not, right? Based on this. Okay? So you can clearly identify the bull market phases, consolidation phases, bull market phase. A very simple, easy tool to use, but it works well on the longer time frames. Okay? You can make this even better, like a few of you are saying, like Rick was saying, add the 100, the 200 period moving average. Let's do that for a second just to show you something. Here, let's go to the moving average, and then I'm actually going to put the simple on. Let's put the 100 and the 200 here. 100, we're going to make red. And 200, we'll make that black. Now, you'll notice on the monthly chart, they're probably way below here. Let's go down to a lower time frame there. So now this just reinforced this. What I'm doing with every step I'm adding is making it even more conservative. Okay? So you can add other ones if you want, but you notice how here we were in between moving averages, right? So if this crossed below, if the 10 weighted crossed below the 10 simple, but price was in between moving averages, you wouldn't take that trade to the short side. You're only taking it when you're either completely above all moving averages or completely below all moving averages, okay? And the thrust points tend to be when you clear them the first time. So when you're in between or you're below and then you move above all of them, there's usually a nice push, right? And then you take every subsequent cross. Again, I'm not trying to give you systems. I'm trying to give you tools that you can add to what you're doing now to help you feel a little more comfortable. Okay? So if you're extremely conservative, like a few of you were saying earlier, and you're worried about staying in a trade, if you use a short period moving average like a 10 and add a 10 weighted, the period of time that the stock or whatever underlying you're using spends above both moving averages is a period of time when it's moving strongly, when it has strong momentum. Otherwise, it will crisscross. Okay? So you're only going in on those periods where there's strong momentum. So yes, you can use like the 20 period moving average, for example, the slope, but you'll notice that most of them tend to happen on breaks of previous highs, breakouts. Long channels, it'll work extremely well, the same thing, or a break above all moving averages and a break above previous highs. Okay? So breakouts. Use this with breakouts, and you're in for a short period of time. Strong momentum moves. These are moves that don't tend to fluctuate a lot. You don't get a lot of this action on high momentum moves. Okay? You get more straight line action, which does what? It helps you relax. It helps you ease your emotions. It increases your confidence, etc. So it allows you to take that deep breath and focus on price action to look for your exit. Okay? So these are things that you can consider adding to what you're doing now. For Fibonacci's, okay? Let me clear this off and quickly show you. Let's go back to, let's go back to Apple, for example, here. And let's take our fib our fib retracement tool. Let's go back in here. Let's say that, I'm going to draw this. I'm going to zoom in here. So you know how normally we look at our 38.2 to 61.8 retracement levels? This is the strongest zone that I found, the one I'm most comfortable with trading, the ones most people trade with. So you're looking for a pullback and a bounce out of this, right? Sometimes it goes beyond it. So there's a few levels that pros use and we'll still look for trades at. And I want to give you these, just so you can decide whether you add them on or not and use them. One is the 66%. Another one is 78.6, and another is 88. Okay? Now, I find the 66 to be more important than the 78.6 and the 88. Again, the reason why is similar to that 65 period moving average. A number of people, when it pulls back to 61.8, they'll go along somewhere in here and put their stop just below that 61.8 level. And then you'll see price either fluctuate around here or just dip slightly below there and come back and take their stop out, where the 66 level will help you out. So you can use that to put your stop just a little further away, a little below there, and that might help. And there's better examples of this. Let me see if I can find a couple for you in here. Oops, let me try that again. Okay, so right in here is that 66 level. Now this one went a little further. Okay, would have stopped you out anyway if you had your stop there. But you see how some trades come a little deeper than that? Those are other levels that you can use. Okay, up to you. I still prefer to use 38.2 to 61.8. Okay, so a bounce like in here, yes, I would have taken in this area. If it had gone beyond, I personally would not. But it's what you feel comfortable with, and it also depends sometimes on the other things you're seeing. So, for example, if this dip was a little lower and you were drawing trend lines from one point to the next, okay? So let's say you're drawing from here across here, and you see how they kind of line up. So if we had come down in here into that zone near 61.8, and you had this support and it's bouncing, yeah, that would be more reason to get in than if there was not added support here, correct? So the last point I want to make is about confluence, right? Is when everything comes together. So this is what I'm talking about. So let's look at J&J here, okay? So we want to look at this area in here for an entry, okay? So let's say that this might have been a proper fib level, a retracement into a proper fib level, okay? There was also support because, there was a previous low here. We had support in this area. Now, if we draw our fibs and this pulls back into a proper support area, great. If we throw on our moving averages, for example, okay, let's do this very quickly. Where are we here? There we go. And let's do the 10 and the 20. Okay, now we have a cross happening as well at the same time. Okay, then we throw something like the RSI on, right? We throw the RSI on. Let's go in there and move this to 7 like we normally use it, right? And take this off, this down to 50. Okay, use the RSI the way we use it with the winning momentum strategy, right? And now at the same time, we have a cross above that 50 line. So this is what I mean, stacking the odds in your favor with all these tools, okay? So now you have, if this were to break this high here, what do we have? We have a double bottom, right? Breaking the high. We have a move above the RSI. We have a cross of the moving averages. We're stacking the odds in our favor. If this was a proper fib level, bouncing off support, all those things come together. These are the tools that you would use to decide between setups. So if on any given night I was looking at 10 different setups, how would I choose one over another? Or the strongest one, the one with the most evidence on my side for me to place that trade, okay? Again, there's a lot of different things you can use. Start at one, get comfortable with it, and then move on to the next. You do not have to use all of these. You can simply follow the strategies that we've taught you in the past, etc. But if you don't understand what you're seeing on a chart, trading is going to be a lot more difficult for you. More importantly, it's going to be a lot more nerve-wracking. In other words, if you don't understand what's happening through this area, then you are going to be nervous. You're never going to know whether this thing is going to turn on you and cause a loss or not. But if you can read it candle by candle and have other tools that support that move, it's going to give you a lot more reason to be relaxed and think clearly and manage your way through that trade. Okay? Any questions at all on that? I'm not sure if Raul's still with us or not.
Yeah, I'm just watching for any questions that come up.
Okay, great.
Most people are saying great session. They're not overwhelmed by the information. They're actually quite enjoying it.
There's one more thing that I wanted to share with you, okay? And I was going to say that trading really can be as easy as 1, 2, 3. And the reason I say that is this, okay? Let's look at an example here. Let's actually, we can just look at Goldman Sachs here. What I mean by 1, 2, 3 is a number of patterns happen that way. 1, 2, 3, like this. If we call this 1, I don't know if I can draw it with my drawing tool here. I'm not going to be able to. Let's mark this as 1. Okay. This as 2, and this is 3. Okay. So we make that move. So starting point 1, 1 pivot, 2 pivot, 3 pivots. What we're looking for to enter is a break of that pivot. So 1, 2, and 3 would be the break, and off we go from there. You see these patterns everywhere, okay? So it's like this is 1 here, 2 here, 3 here, right? What do you look to enter? On a break of there. So 1, 2, and break through here, and you go short. But you can look at these individually like this. Let me clear this off. First, I'll draw it. You have 1, you have 2, and you have 3. That turnaround pattern, okay? Where on a higher time frame chart, it would look more like this. It would look more like a reverse hammer, for example. In other words, we kind of started here, we went all the way up here, and then came all the way back down. So, we started here, buyers brought it up, sellers said no, 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 and brought it all the way back down. It's a reversal signal. So what you're looking for is a breakout of that turnaround. Opposite is true going the other way, right? You have a candle like this, you have one lower, and then you have something like that. Okay? And sometimes it's not 3, it's 4. It could be like this, right? And then the next one is where it actually breaks above this high, okay? But it's that reversal price action. So if you look in here or in here, okay, you get that turn where you started here, you start selling off, and now you break that high. And there's your breakout. Now, it may happen as a consolidation. It could be a little flag where it's just consolidating a little downward, but it's the break of those highs that are very, very important. The major pivots give you an idea of the major move coming. And again, the more these are associated with other things you look at, like the cloud, for example. Okay? So let's see if this lines up at all. Let's put on our usual layout. Go back to Goldman Sachs and see here. So these were the 3 points we were looking at. 1, 2, and 3. And this was the break we were looking at. Okay? Well, what happened coming out of that break? The moving average went back in the cloud and then came back through it with a slope, which we always say tends to lead to a bigger move. Now you have more evidence. You have 1, 2, 3. Whether you call this a double bottom or not doesn't matter. Okay? If it was at the same level, so be it. It's more evidence, right? Now, what if in here, right at the break, you get a bullish engulfing pattern, for example, or a long hammer candle, or other reversal signal? Or what if there was a gap lower and then a gap up, and you have an island reversal, right? All of those are evidence to what is about to come here. Okay? Then you enter that trade based on your money management rules with proper size, knowing where your stop is going to be ahead of time, and knowing what system you are going to use for exits, knowing where you're going to scale out, if anything. You could use your fib extension tool, most recent low to high. Now you have targets of where you're going to scale out. Okay? So take it one step at a time, and eventually they all come together, and you only use the items that you're most comfortable with, that don't allow you to bring your emotions back into trading, but that allow you to remain calm and work through this. Okay? Any last minute questions?
Venus says, how do you create a watch list with so many stocks and other instruments to choose?
So you can whittle it down. Number one, like I said, I use the 30 stocks in the Dow 30, the 100 in the NASDAQ 100, and the 500 in the S&P large cap. So that's 630 stocks out of thousands and thousands in the market that I will start with. You could, if you're into fundamental analysis, for example, use something like the IBD top 50 or top 100 and only focus on those. just find a starting point. But I find the main big names like the Dow 30, the 100 in the NASDAQ, and the S&P, those are some of the biggest companies out there, and it's a great starting point.
And Melanie was asking at 28 minutes past the hour, so about 7 minutes ago, if you could apply this quote to trading crude oil. I'm not sure what technique you were referencing at that point.
Yeah, if there's a specific technique, let us know. But otherwise, yes, you can. Absolutely, you can. So if you look at the chart of the crude oil futures, very choppy, very ugly chart. So it's even more important to follow price action here. So
now she's referencing confluence.
Yes. Now, with such a choppy chart, it's going to be a lot more difficult to find multiple pieces of evidence here to take a trade. But that in itself is a clue. So for those of you who are more conservative like me, you should be focusing on confluence. You should be focusing on the trade setups that have many different factors pointing in the same direction. The fact that this is as messy as it is, and it's going to be very difficult for you to find many reasons at the same time to go short here, for example, is a clue that maybe you shouldn't be going short here. And maybe not because crude isn't going to continue going lower. I think it will. But again, should I trade on my opinion or on what's on the news, or should I trade with what the chart's telling me? If this is choppy and ugly, chances are I'm going to get stopped out pretty quick because it should continue being choppy and ugly. Now, if we go to the higher time frames, it's a lot smoother. Chances are I'm going to be able to find some confluence on the longer time frame. So maybe I use that. Maybe I look at a longer term play here, or maybe I just look at the overall direction and I say, well, the monthly is still telling me that this is going to go lower. So I'm only going to look for short trades. And yes, I'm going to understand that they're riskier in nature because of the choppiness of this time frame, but I'm willing to take that risk and I'll take it short. But that's the funny thing about these simple techniques, is that when you're asking yourself questions like that, or having difficulty finding charts that are setting up properly, that is a clue in itself. Okay, I forget who it was that mentioned earlier that she's a little frustrated with the sideways action, right? That the consolidation phase that we're in. That frustration oftentimes is a sign that maybe we do need to sit on the sidelines and wait for the next clear direction of this move, right? So, especially if it's followed by a period that was a strong trend and now we're consolidating, maybe we should be waiting until we get a clear signal one way or the other. See, sitting on your hands throughout this period here is very difficult. I've said it many times. The most difficult thing for a trader to do is to do nothing. Because as traders, we want to trade, okay? But we're above the cloud here. But what the chart is telling us is that this trend is over here. The moving average is sloping lower. Momentum is to the downside. Now, we shouldn't be shorting yet unless we want to be aggressive, because we should only short below the cloud, okay? But we shouldn't go long in this area. What would have happened if we tried to go long at any point in here? We would have been stopped out and taken a loss. Now it comes through and regains momentum. Okay, still sideways, pulls back again, and now it starts to take off. And if there's any signal in here, and there was a cross, there's the RSI, cross, there's your entry, and now you come in. So if you traded here, and you traded here, and you sat on your hands throughout here, wouldn't you be much better off? So when you see this, the only question you need to ask yourself is, where else do I look for this kind of setup? Maybe it's not equities. Maybe it's Forex. Maybe it's gold, crude, anything. But here you need to do what the chart's telling you. And if it's telling you to sit on your hands, then sit on your hands.
All right, Cynthia says, Vince, when you're looking at futures charts, do you look at the extended hours as well?
I yes, I do. I do, especially not to trade in aftermarket, but for an indication of what I expect when the market does open. So I do. I always keep an eye on the futures, but especially if there's some news announcement that you think can affect whatever it is you're trading, then definitely have a look at them. They'll give you an indication of where things are going.
Gwen says, I use weekly for overall trend, then look at the daily for entry and exit. Is this something that you do as well?
Yes, absolutely. I also really like the monthly as well. I'm more and more I'm looking longer term. I love finding these setups like Citigroup where they were in the doghouse for a very long time, consolidated, and now they're starting to break out. There's so much room for upside, and finding those and then moving to a lower time frame and look for entries, it works really, really well.
All right, Luis, last question. Do you sync your trades with how the general market is going? Or if you get a great trade set up in the S&P, is in correction mode, do you still take the trade?
So this is why you need to take it one step at a time and get comfortable with it. So for me, for example, I've traded with my strategies for many years. So I'm going to be comfortable taking a nice, strong setup regardless of when it happens. But the overall market is part of that confluence that we've been talking about. So ideally, you want the overall market in your favor. You want your trade to be in the same direction as the overall market. All right? And you want all the supporting factors. So if you can find that, perfect. If you can't, but you still might have 3 or 4 other reasons why you want to take that trade, then you can. It always comes down to how aggressive or how conservative you want to be, and you finding your comfort zone. I can't stress it enough. I know a lot of people overlook that, and they feel like, you're not a real trader unless you're willing to risk it all. And it's BS. You're just asking for trouble. Do what's within your means. That's what will help you the most.
All right. Michael says, this may be a question for a different setting, but do you recommend purchasing and holding options or actual stocks or ETFs for managing nest egg, or I guess retirement type accounts? What do you consider?
It's actually a combination. So for longer term, because you're in it for longer, in order for you to maximize the amount of profit on that trade, you want the ability to do a number of things with that trade. So you want options, and what I don't mean options that like the tool that you're trading. I mean you want the opportunity. So if I'm buying the stock here, for example, on Citigroup, I'm buying actual shares. Now they pay a dividend. So if I'm holding for a longer period of time, I'm going to be collecting those dividends and reducing my initial cost basis. So that alone will help buffer any loss if there is some longer term, right? Because the longer I hold it, the more I'm receiving in dividends. So, but if I'm holding the stock, I don't want the risk associated with any huge gap against me or anything like that. So I'm buying a put option along with it, and I'm locking in the amount of risk I'm taking so that it's within my risk parameters, right? Then along the way, depending on what this does during, fluctuating back and forth, and it could all be based on the lower time frame, I may be selling calls here, buying them back here, buying calls to add to my stock position, selling here, and so on. So I'm looking for opportunity along the way to squeeze as much out of it as I can. And so for me, it's never about, you look at a company like Apple and say, well, they're going to continue making great products. They're very profitable. I think in the long run, I can only make money. So I'm just going to buy some stock and sit on it and do nothing else. You're not getting the biggest bang for your buck that way. You really do need to look at the chart and try to decide when is the right time to hold Apple and when isn't. And again, the chart will tell you that. So if I'm looking here, did I really want to sit through Apple throughout this pullback? So if it's giving me a sell, I'm out of there. Then I'm only getting in when I'm supposed to get back in, right? But along the way, during these pullbacks here, if you're seeing this on the monthly, on the daily, it's a much bigger pullback and creates opportunity to add to your position here with some calls along the way. So it's all about opportunity.
One last question. Gerald had asked this earlier. How many open trades do you manage at any one time?
That comes down to the money management strategy. So for example, I have a rule where I won't put any more than 5% of my account balance in any one trade, right? But I also have a rule that states I cannot have more than 50% of my account in the market at any one time, right? So at worst, I have half my account in cash at any one time. That avoids any huge loss for me, right? Now, some of you may think, well, that's dead money. It's just sitting there. No, it's not, because it allows me to sleep at night and allows me to know that there's no way possible for me to take a big loss following those rules. So going by that math, 5% in one trade, no more than 50% in the market at any one time, that's maximum of 10 trades at one time that I can have on. My rules won't allow me any more than that. Now, if I go to 2.5%, I can put on 20 trades. But what I found is that any more than 8 to 10 trades is very difficult to keep track of. So for most of you, either starting out or if you haven't built all the right habits yet and are not managing your trades properly yet, I would not have more than 5 trades open at any one time. What you want to do initially is learn, okay? Now, some of you may be doing this for a living and may feel the pressure of having to make that income as quick as possible. But when you're forcing your trades, you're going to make mistakes and you're going to jeopardize your long-term success. So take it slow, put only a few trades on at a time, only what you're comfortable with, and then go from there.